Battered 60-40 strategy followers face more pain as yields rise. Not gonna lie, I'm a sucker for clickbait, and I don't know if this is clickbait or not, but battered 60-40 strategy is like, whoa, I didn't know people getting battered in a Wellington fund. What? Liz McCormick and Cameron Kreis, after, this is Dateline a couple days ago, but 9/28, after already registering the worst monthly losses in almost a year in September, little relief appears in sight for investors adhering to the 60-40 stock to bond portfolio strategy. That traditional portfolio was down about 97 basis points in September, basically 1%. That's the biggest monthly loss since October of last year. And yields are moving higher again on Monday, while equity prices are mixed. This is again a couple of weeks ago. The S&P 500 was down about 1.5% in September. Benchmark treasuries briefly topped 1.5 on Monday, and now they're at 1.6, which is the highest since June, continuing the upward momentum since the Federal Reserve signaled last week that policy normalization will start in November and rate hikes could potentially begin next year. I highly suspect that's not going to happen. The economy isn't roaring, that's for sure. They're not going to raise into a non-roaring economy. 10-year yields rise of 20 basis points since last Fed meeting should provide support for spread, widening pressure on investment-grade credit debt portfolios, says some guy. This in turn should have an adverse effect on the 60-40 portfolio underperformance, which could also have a negative effect on equity returns over the near term. Oh, God, just such... No one knows anything. A negative return, negative effect on equity marks over the near term. What is the near term? Exactly. Portfolio pain. So look at this. In November of last year, the 60-40 portfolio was up 700 basis points, 7%. The 2 months previous to that, it was down 2%, 2%, up 7 to 8%. Up 2%, down 1%, up 1%, up 2%, up 3%. Well, that's actually 4%. Up 1.5%, 2, down 1. Portfolio pain when you're down 1 in 1 month. When the rest of the months you've had 1, 2, 3, 4, 5, 6, 7, 8, 9 consecutive, well, not 9 consecutive, but the previous 1, 2, 10 months, 9 were up in significant amounts. It's freaking nuts, man. Adding to the mix of woes that could weigh on equities and developing energy crisis that dampen global growth and add more momentum to already high U.S. inflation indicators. There's also a slew of Fed speakers this week, including Powell, so their insights may help clarify the market's outlook of the... this is just freaking... All right, so let's take a look at something. So here's Wellington. So far this year, it's still up 5.94% as of close of business on Friday. All right, so... The last, it fell from, we started in January at $10,000, and the Wellington is in the blue. It went to about 10,750 at the end of August. It fell to 10,500 at the end of September. So basically lost $250 on 10,500 or 10,750. There we go. That's a 2.3% loss for the month of September, basically. Again, we were at 10,750. We went to 10,500. So we lost 250 dollars on 10,750. 2.3% is down in the month of September. Wow. Yet we started again. We started the year at 10,000. We're still up to 10,500. All right. I just don't find that to be that big of a deal. To say the battered, the pain, we're still up, dude. You're losing 1%. That means you're getting pain. You're getting battered. It's not. So give me a break. And then I hate to say it again, but look, this is where we were in 2016. We had $10,000. This is where we are now. We got $14,900. We're up 45% in 5 years' time. So we're down 1% and 2% in 1 month after having spectacular months before that. That's why the financial media drives me up the wall. It's like, man, give me a flipping break. If that's pain, then what's going to happen when the real pain comes in? You can't listen to these people, man. They just love to make you scared because I don't know why. I guess they sell product. I don't know. All right. Love to hear your thoughts. We'll see you.